Hey, everybody. Welcome to this week's podcast. It's week 45, and today is Feb the 13th, 2026. It was a big week for the grains markets. It was WASDE week. Plus, I believe this week's podcast has more of a China flavor. What's the topic?
Yeah, so the February crop report was a big win for soybeans. We'll explain that and the one-year trade truce extension. So let's get into it. Here's your weekly market quote summary. And I think the big win this week was the vegetable oil soybean complex. You can see soybeans, meal, oil, canola all higher. But we also had a late breaking spike in wheat. That could be a technical breakout. We'll get into that. Hogs, we're not surprised we got the correction. We warned everybody that hogs were ahead of themselves short term, and then cattle did actually trade to new contract highs this week. So let's start off with this February crop report.
Yep. So, like we were discussing, it was the Feb WASDE week. But before we get into some of those numbers that we got from the Feb WASDE, USDA basically acknowledged Trump's comments about China possibly increasing their soybean purchase. So, as we remember, the earlier figure was 12 million metric tons. So, USDA is basically saying that the possibility of them increasing it to about 20 million metric tons is possible. But USDA did not make any changes to the balance sheets in the Feb WASDE, though, which is good news, which is a win. And possibly that says that we could have more demand coming on board and further reductions to that ending stocks figure. And in terms of the numbers, it was basically bullish corn in terms of ending stocks. So ending stocks came in lower than last month, owing to higher exports. All the other numbers were closer to expectations, Mo.
Yeah, so ending stocks did fall 100 million. Nobody expected that. We're not surprised. That's what we were forecasting. And why did the market not react? Because it's still 2.1 billion. I think the market needs something below 2 billion for them to maybe start to ration some demand, because you do have a lot of bushels. But here's the good news. The trade has been talking about how feed and residuals have been too high. It eventually needs to come down. It needs to offset that higher red hot corn export program. Guess what? They didn't do that. Why? Because the crushing report suggesting that even though the corn crop last year may have been record strong, the quality's not there. So we're feeding too much corn to make ethanol. We're feeding too much feed to animals to get protein. So I think that this is a good news story, and I think in the coming months, you're going to see ending stocks drop to 1.8, and I think futures are going to react accordingly. And I think even though we had an early February high last year at 5,520, I think this year that 5,520 could happen as we get into late spring, summer. Oops.
In terms of the global numbers, as you guys can see, for corn, it came in lower than last month and lower than expected, which is bullish. Soybeans was close to expectations, slightly higher than last month, and wheat came in lower than last month and expectations. On the South American side of things, not a lot of change except for that Brazilian soybean crop keeps getting bigger, 180 million metric tons. That's huge. And Argentina corn and soybeans unchanged.
Yeah, South America doesn't look like there's any changes. The 2-week forecast looks like it's going to bring rain back to Mato Grosso. The crop conditions in Argentina continue to drop, but it's too early for the USDA to drop production. It's only February. They're used to slow walking it, and I think you might have to wait till April or May before they start to drop some of those numbers.
Some good news for the grains and specifically for soybeans again. The South China Morning Post reported that President Xi and President Trump are expected to extend that one-year trade truce when they meet at their summit during early April. And Mo, talk to us about that trifecta of factors that are actually boosting soybean futures.
Yeah, so I hope you guys are enjoying the party because we are. We have not sold a darn bushel of beans. We've been projecting this. So it started 2 weeks ago. We've talked about it in past podcasts. If you remember, you've been getting a ton of emails and reports and recommendations from us and what to do, what not to do. When Trump suggested that China was going to buy 8 million metric more tons, that was your first positive headline news. Then the USDA confirmed that comment in Monday's USDA February crop report. And of course, Abhinesh just talked about the China Morning Post comment that the trade truce in April could be extended out a year. I think the market's looking to see if the 10% on U.S. soybean tariffs will get removed, because right now it's the Chinese government that's buying, not necessarily the private crushers. And again, most of the trade has gotten this wrong because they keep talking about how, why is China buying? They don't have the space. The Brazilian beans are much cheaper. Don't try to overthink this. This is a political buy. It's all about politics, not about economics. And so that's why you've seen this spike. And this spike here, this latest spike, is more, you can see from the chart here that it's more parabolic than the first one, which was in November. Okay, it has more of a 90-degree angle to it. And so the markets haven't told us that this has come to an end. We have a 3-day long weekend. We did correct slightly today because nothing goes up in a straight line. But you are approaching, and this is the July daily futures chart, but you are approaching that peak right around that 1069.5 to about 1091. And I think this second go around, there's going to be enough positive information that I think we can take it above that high. And we've suggested, that we could get to $12. You break $12, you go to $12.31, and then eventually it's beans in the teens again. Marketing is like a game of poker. I try to compare it to a game of poker because you got to know when to hold and when to fold. And I know this is the most hated soybean rally in history because you guys sold too early, and I understand. You got to sell to grab some cash flow and pay some bills. But if you can remain patient and let this play out, you too can participate in higher prices. Don't forget to try our program, join the marketing club. This past week, we had our USDA February post game plan. What do you do after that report? And we also talked about March basis contracts for 2026. What do you do? Do you fold? Do you hold? If you want to learn more about what our forecast is and what to do, then try our program. Sign up. All right, so let's talk about this new mini ethanol boom, Abhinesh.
Last week we spoke about 45Z and touched upon the new biofuel policy. 45Z tax credits are reshaping the balance sheets of ethanol plants, and in turn it has the potential to boost the profitability of farmers. US Ag is stepping into what can be termed as a mini ethanol boom, and that is according to Scott Irwin from the University of Illinois. After more than a decade of flat production capacity, the industry is suddenly expanding again. For ethanol plants willing to invest in carbon capture and storage, the financial upside shifts from strong to staggering. If ethanol plants can manage large scale, we are talking hundreds of millions of dollars for the 4-year incentive period, which is from 2025 till 2029. A 200 million gallon ethanol plant could make as much as $500 million or more during that period.
So current ethanol plant in the U.S. can make as much, their margins are around 12 cents per gallon, depending on the day and the month. But now they can qualify for an additional 11 cents in credits. So that literally doubles their income. So a lot of local ethanol plants are looking into participating in this program. And in that carbon capture and storage, CCS, under 45Z, it can capture an additional 60 cents per gallon each year. So they can make as much as $120 million more per year. That is huge. These plants will start running 365. They'll put up more plants. How does a farmer participate? Well, two ways. One, this is going to create additional demand locally, which increases the basis by 5 to 10 cents. But if you can help that local plant increase its CI score, lower that CI score, you can make as much as an additional dollar per bushel. By lowering that CI score, that plant can make an additional 2 cents per gallon. So this short term is very positive for that U.S. farmer that's struggling with margins and low crop prices. So, start talking to your local ethanol plant, because I think it could help you make some more money into 26.
There's headline news that China has banned phosphate fertilizer exports, and this is owing to their continued strict control over phosphate fertilizer exports. And this is as of early this year, with reports indicating a suspension of shipments until at least August 2026 to ensure domestic supply and stabilize local prices. As the world's largest exporter, this move acts as a de facto ban, significantly tightening the global balance sheets for some of those fertilizers.
So I brought this up because we're getting a lot of questions about fertilizer. There's a lot of folks that are sitting on the fence, don't know what to do. And this was a story that came through at the end of 25, early 26. And China, if you know anything about the global fertilizer balance sheet, they're one of the major exporters around the world. And the fact that they've decided to restrict those exports is a big no-no for the balance sheet. So for those of you who think that in the spring you're going to get lower prices, I don't think you will. You can see from this chart, this is MAP and urea are the two that have been slowly increasing again. But we're down from the highs in 2022, but you can still see that we're higher than where we were. And unfortunately, when you've had 3 years of low crop prices, those inputs, those sticky elevated input prices are tough to swallow. So just a warning, talk to your local supplier if you haven't done anything. But I keep getting reports that it's going to be tough to find supply in the spring. So we would not wait till the spring.
There's also headline news regarding, sticking with China, despite last year's record corn harvest, some of northern China's crop was battered by heavy rains during harvest, rendering some of it moldy. But no official damage estimates have been issued, despite some private estimates pointing to up to 30 million metric tons of Chinese corn, which may have been damaged. The surge in Chinese feed grain imports has underpinned prices in exporting countries. In China, the national average corn price was up by about 10% year on year and reaching about 8.28 US dollars per bushel when you convert it.
This story is old news, but I'm bringing it up because the trade is talking more about that poor quality corn crop in China. And I bring it up because lately they've been buying some more barley from Australia and some sorghum from the U.S. So as Xi and Trump meet in April, could China start buying more U.S. quality corn? Now, again, I just talked about how poor the corn crop is in the U.S., but nonetheless, it could just add to that red-hot export pace.
Well, they've been buying a lot of feed grains off late. Chinese buyers have ramped up feed grain purchases in recent months, taking large volumes of Australian barley and also U.S. sorghum after rain damaged their domestic corn crop. Importers have booked about 45 cargoes, or at least 2.5 million metric tons of U.S. sorghum over the last 3 months. And this is 3 times the quantity shipped in all of 2025. Chinese buyers have also bought 1 million metric tons of Australian barley a month since December, around double last year's monthly volumes.
Yeah, so again, we don't know if there was quality issues. There were heavy rains, but we'll know if there's a problem when it turns into demand, and it looks like it's turning into some demand for sorghum, for barley, and maybe for corn. We've seen some daily USDA announcements where we've corn sold to unknown, and I know the market doesn't think unknown is China, but we do. It's always been China to some degree. So I think China's already buying that corn. So maybe we'll see more of it in the future.
Let's switch to wheat futures. Winter wheat futures are spiking, either testing or nearing their respective 200-day moving averages on the daily charts, with funds still short about 110,000 contracts in wheat. Better technicals and fund flow seem to be driving the bus higher after recent winter kill fears.
Yeah, so this is bullish short term for wheat. I'm a little surprised. You can see the spike here. This is Chicago wheat, Kansas. It's the one that's ahead of the three flavors, and you can see that this is your slight upward channel that we've started to create. And if you look at this is sort of a long-term double bottom. And so it just tells us that the bottom's in. And, we've always talked about we need to get back to the mean or average of 200 and spike above it. This is not necessarily providing a selling opportunity for most farmers. You can see the resistance at 575, but perhaps as we get into the spring, maybe we get a production hiccup, maybe we lose more acres somewhere, maybe a move back up into this area here would be quite positive. But it's a good sign, both for, we haven't seen a technical breakout just yet, we need more confirmation. You can see here, Chicago soft red winter wheat is almost near the 200. Minneapolis continues to lag.
And we had the latest CFTC numbers released a little earlier today, and this is data as of the 10th of Feb. As you guys can see, more buying in the grains, in corn. Spec funds bought about 20,576 contracts, again, reducing their net short to minus 48,210. And on the soybean side, big buying taking their net long position to 123,148. What do they do in canola? Again, significant buying in canola. That color should have been changed to green from red as far as canola's net position is concerned. So they are net long 47,408.
Yeah, that's a big surprise. I didn't think they were that long. I thought they were long, but not long 47,000. And by the way, in real time, we think the funds are long soybeans of about 100 after this week's buying and move higher. I think they're long 167,000. So still behind that 232,000 from last November, but getting closer and closer. And you can see here that the funds are still short wheat of about 110,000. So if there's more fund flow going into ag and we're spiking in wheat, if the funds want to continue to cover the short positions in wheat because of better technicals, then we still got some more movement to the upside here short term. So enjoy the long 3-day weekend. We'll see you again next Friday. Take care.
Did you have a message for us?
Oh, yes. Sorry. I always forget the darn message. Just referring back to soybeans, the trend is your friend. As long as we keep closing higher each day, you're not going to get that every day, but that's the trend is your friend. So until that ends or bends, as the other sayings say, I think you just keep riding it higher. So we'll see. Hopefully there is a weak seasonal in the next 2 weeks, but maybe that seasonal won't work. Maybe we need another headline news from Trump, or you know what? If we get some USDA flash sales that China's buying, that could really spark the market higher. So the trend is your friend. Take care, folks.
Bye guys.
Now.